Ever wondered what a candlestick chart really reveals about market movements? It's more than just a series of colored bars. At its core, a candlestick chart offers a snapshot of price action over a specific period. But let's break that down. Each candlestick represents four crucial pieces of information: the open, the close, the high, and the low prices for that time frame. Picture this. You're at a bustling marketplace, and each vendor sets their price based on the day's negotiations. The opening price is like the price the vendor first puts out at the start of the day. As the day goes on, some customers negotiate for lower prices, while others are willing to pay more. The highest price reflects the most someone was willing to pay that day, while the lowest price shows how low the vendor was willing to go. Now, when you look at a candlestick, you see a thick body and thin wicks, or shadows. The body is colored based on the price movement. If the close price is higher than the open price, the body might be green, indicating buyers were in control. Conversely, if the close is lower than the open, the body might be red, suggesting sellers had the upper hand. And here's the surprising part. The length of the wicks tells you about the volatility during that time. Long wicks indicate wild price swings, showing that buyers and sellers were battling it out. So a candlestick chart not only shows where a price started and ended, but it encapsulates the entire story of market sentiment and volatility for each period. Understanding this helps demystify market movements, giving you insight into the psychology behind the trades. Have you ever looked at a candlestick and wondered what story it's trying to tell? Each candlestick is essentially a mini biography of market action over a specific time frame, and it reveals four key elements: open, close, high, and low. Let's break that down. Imagine you're reading a story about a thrilling race. The open price is like the starting line, where the action begins. This is the price at which a stock or cryptocurrency first trades at the beginning of that time period, whether it's a minute, an hour, or a day. Now, as the race unfolds, the price moves up and down, just like runners jostling for position. The high price is the peak moment in our race, the highest price reached during that time frame. It shows how far the price can go when the excitement is at its peak. Then comes the low price, which acts as the lowest point reached, like a runner who stumbles or falls back a bit. This is the lowest price during that time frame, revealing the challenges or hesitations in the market. Finally, we have the close price, which is like crossing the finish line. It tells you where the price ended up when that time period wraps up. If the close is above the open, it's like a victory lap. If it's below, it's more like a disappointing finish. And here's the surprising part. This combination of open, close, high, and low creates a visual representation that allows traders to quickly assess market sentiment. Each candlestick is packed with information, helping you to see the bigger picture in what might seem like just a jumble of numbers. So next time you look at a candlestick chart, remember, each one tells a complete story about the market's journey for that time frame. Curious about how these stories connect over time? Stick around. What does the open and close price really tell us about the market? Think of the open price as the starting line of a race. When the market opens at a specific price, it sets the stage for all the action that follows. Now the close price, that's the finish line, where the race concludes and the final score is tallied. If the close is higher than the open, it's like saying the buyers sprinted ahead, pushing the price up. This indicates strong buying momentum during that period. Conversely, if the close price is lower than the open, it signals that sellers took control, dragging the price down by the finish. But here's the surprising part. It's not just about who won the race. The distance between the open and close also tells us how fiercely buyers or sellers fought for control. A larger distance indicates a strong battle, while a smaller distance suggests a more subdued contest, where neither side made significant ground. For example, imagine a candlestick where the open is at $50 and the close is at $55. This shows a clear victory for buyers. However, if the open is at $50 and the close is at $51, the buyers may have retained control, but just barely. It's a subtle but important difference. Understanding the open and close gives you insight into market sentiment during that time frame. Were buyers bullish or were sellers bearish? These two prices are like the heartbeat of the candlestick, revealing the underlying pulse of market dynamics. So when you look at a candlestick, remember that the open and close are your indicators of who's in charge, and they can tell a much deeper story about market movements. Keep this in mind as we explore more about candlestick patterns and what they reveal. Imagine a balloon. When you inflate it, it expands to a peak height, and when you let air out, it shrinks down to its lowest point. This is similar to what a candlestick chart shows with its highs and lows. Each candlestick represents a specific time frame, maybe a minute, an hour, or a day. The top of the candlestick is like that peak of the balloon. It represents the highest price reached during that time. Conversely, the bottom of the candlestick is akin to the deflated balloon, showing the lowest price within that same period. Now, why is this significant? The range between the high and low illustrates market volatility. A larger range indicates that prices swung widely, suggesting more significant buying and selling activity. On the flip side, a smaller range indicates stability, where prices hovered around a more narrow band, indicating less excitement or movement in the market. And here's the surprising part. While many traders focus heavily on the closing price, understanding these highs and lows can reveal a lot about market sentiment. For instance, if a stock reached a new high but closed near its low, it might indicate selling pressure at that peak. Traders see this as a sign of potential weakness. Conversely, if a stock hits a low but closes near its high, it's often viewed as a recovery signal, suggesting buying interest has stepped in. So the highs and lows of a candlestick can paint a compelling picture of market dynamics, highlighting volatility and potential shifts in momentum. Understanding this gives you a clearer view of how prices are moving, which is key to interpreting the market's behavior. Have you ever wondered what the colors on a candlestick chart really mean? It turns out those colors are more than just decoration. They embody the market's mood. When you see a green or white candlestick, it usually signifies that the closing price is higher than the opening price. Think of it like a happy face. People feel confident, and the market is buzzing with bullish sentiment. Traders are buying, and optimism is in the air. On the flip side, a red or black candlestick signals that the market has closed lower than it opened. Imagine a frown. It reflects uncertainty or disappointment, suggesting bearish sentiment where traders might be selling off assets. This color coding is like a psychological thermometer for market sentiment, helping traders gauge whether the atmosphere is more optimistic or pessimistic. But here's the surprising part. It's not just about price movements. Emotions play a huge role in trading. These colors tap into human psychology, where green inspires confidence and red stirs up fear. Traders often react to these colors instinctively, perhaps selling out of fear when they see a series of red candles, or buying eagerly during a string of greens. Understanding this emotional layer can give you insights into market behavior. When you see a sudden shift from green to red, it might signal a change in sentiment that's worth paying attention to. So the next time you look at a candlestick chart, remember, it's not just about numbers and prices. It's about the collective mood of the market, captured in those vivid colors. Curious about how these candlesticks can guide your understanding of market sentiment? Subscribe for more insights into the world of trading. What does a series of candlesticks actually reveal about the market? It's easy to get lost in each individual candlestick. But here's the thing. When you step back and look at a collection of them, you start to see a bigger picture, much like watching a movie instead of just a single scene. Each candlestick represents a specific time frame, let's say a day, and shows you the price action within that time frame. But when you line up several of these candlesticks, you begin to notice trends. Imagine you're tracking the weather. One day might be sunny, another might be rainy, but when you look at the forecast over a week or month, you start spotting patterns, like a sunny spell followed by a storm. In trading, these patterns can indicate the market's direction. For example, if you see a series of green candlesticks rising one after the other, you might identify an uptrend, suggesting that buyers are increasingly willing to pay higher prices. Conversely, a series of red candlesticks could indicate a downtrend, where sellers are pushing prices lower. And here's the surprising part. A long series of red candles followed by a single green one might suggest that buyers are stepping in after a downtrend, a potential reversal point. In essence, by observing these candlestick patterns, you can start to decode market behavior over time. It's less about predicting the future and more about understanding the underlying momentum. So remember, every candlestick is a piece of a larger puzzle. If you find this way of piecing it all together intriguing, you know what to do. Vocabulary: candlestick, trends, patterns, momentum.